Thank you again for tuning in to our Retirement Education Center YouTube channel, where on this channel, we believe in providing you unbiased advice to help you maximize all of your retirement income. Now, on our channel, we do not believe in providing you any silver bullet strategies or glorifying any type of one product. But what we do believe in are holistic concepts to help you retire with confidence. Now, when it comes to investing, many people clearly understand that there are going to be taxes involved in one way or another. Now, the one thing that you have to be aware of is how do you make your taxation on your investments more efficient? That is what we are going to be covering in our short educational video today, so you're definitely going to want to stay locked in. Hi, my name is Carson Graves, President and CEO of the Retirement Education Center.
And I'm Andrea Graves, Director of Operations at the Retirement Education Center. And we want to thank you for tuning in to our Retirement Education Concepts videos. These videos were created to help to make the difficult and confusing retirement process simple.
Absolutely, Andrew, because with so many retirement concepts out there, so many retirement strategies, and of course, with so many retirement products, it can become very difficult for consumers to digest it all. That is why we're so fortunate that we work with a full team of advisors to help us build a financial roadmap that's going to let our clients know when, where, and how they can reach their retirement goals.
For additional concepts on how to maximize your retirement, please subscribe to our YouTube channel and hit the notification bell to be notified when we upload new videos. Now, Carson, accumulating assets is part of everyone's goals, but at some point we may have to use that money. But you say that there's like a big tax bomb at the end of that rainbow, right?
Yeah, unfortunately, Andrew, it is. You know, we all do like to accumulate dollars, but unfortunately, all of that money is not going to be ours. And so when you're actually sliding down that rainbow into that pot of gold, there's probably going to be a little leprechaun that's sitting there waiting on you to get his fair share. And so what we try to do, Andrew, is educate our clients and hopefully educate those who are tuning in on strategies on making sure that maybe you can minimize the amount that the little leprechaun is going to want to take from you. So we're going to be covering some investment tax issues and strategies that you need to think about when it comes to your investment goals. But before we do that, there are always two rules to retirement income we like to give you. And Andrew, what are those two rules?
Well, rule number one is to never run out of money. And rule number two is to never forget rule number one.
All right, so let's go ahead and talk about maybe some ways to keep the little leprechaun out of your pot of gold.
Now, Carson, most people are familiar with investing into a company's 401k plan, but millions of individuals are starting to open up brokerage accounts to invest in meme stocks, Bitcoins, and other stock investments. So what are some of the tax implications to be aware of?
Yeah, Andrew, as you mentioned, 401ks, they're very simple, right? Because people who invest in their 401ks or 403bs or other retirement plans, they're basically on autopilot. Those dollars are going in, those taxes are deferred to a later date, and then they will pay taxes when that money comes out at their ordinary income tax bracket. But as you mentioned, millions of people are starting to open up brokerage accounts. We saw this with Robinhood. We had so many new investors coming in, investing in meme stocks and Bitcoins, like you mentioned. And some of the things that they're going to be faced with is a new type of taxation, and that will be things like capital gains or dividends. So let me first talk about the capital gain. Now, this is a unique type of earnings that you can earn on your investments, Andrew, that people should be aware of if they're new to this. Now, if you have capital gains, you have a very favorable tax treatment of those gains. It can be anywhere from 0%, 15%, or 20%, depending on your tax bracket. And if you want to know where you fall, Andrew, all you really have to do is simply go to Google, type in capital gains tax bracket, and you'll see a chart where you may fall in and what your capital gains tax rate may be. Now, with that being said, Andrew, there are two types of capital gains that people should be aware of: short-term capital gains and long-term capital gains. Short-term capital gains, Andrew, is that you held a stock for 1 year or less. It's very important that you understand the differences here, because if that is the case and you have short-term capital gains, that favorable tax treatment that I mentioned, you will not be awarded. You will be taxed just like money coming out of your 401k at your highest tax bracket. And if you're in the 37% tax bracket, that is what you will be taxed at on your short-term capital gains. Therefore, Andrea, you want to make sure that you do hold that position longer than 1 year, because at that particular time, those are long-term capital gains. It's just longer than 1 year. That's where you'll get the favorable tax treatment of either 0%, 15% on those gains, or 20% as well. Now, one of the things that we want to make note of as well when it comes to capital gains, Andrea, because you did mention meme stocks, Bitcoins, you're probably going to have maybe some short-term or long-term capital losses also. Now, when it comes to short-term losses or long-term capital losses, make note that you can also take advantage of that. You can write off $3,000 each year against any type of income that you have for that year as well. So let's just say you had $50,000 of earnings, Andrea, your ordinary income earnings. If you had a capital loss of $3,000, you can deduct that from that income for that year. Now, another thing to make note of too in this situation is that if you have more losses than that, you can carry it forward. And I'm pretty sure that many people who are investing in Bitcoins, they may have experienced more losses than $3,000 if they were actually a little bit too aggressive in putting their money towards that direction. So let's just say, for example, Andrew, if an individual had a capital loss of $10,000 for that year on a position, they can write off $3,000 in year one. They can carry forward the other $6,000, Andrew, and write off another $3,000 in year two. And then they will have an additional $1,000 they can carry forward in year three to write off of income at that particular time as well. So you can't write all of it off in 1 year, but you can write off $3,000 and carry forward any unused amount in other years. Andrew, one of the things that people may also hear if they're actually an investor is something known as tax loss harvesting. Now here you can couple your gains and losses. So if you had a $6,000 gain on a position, but you had a $3,000 loss on another position, then basically you can just use that $3,000 loss and couple that with the gain for a total long-term capital gains of $3,000, or short-term depending on when you held that position. So it is important to understand that if you're in a year in which you have high income or you have high capital gains and you're looking to get out of that position and you also have losses, tax loss harvesting may be something that you want to consider. So this is why it's so important that you speak to a qualified advisor that can help you understand these concepts.
So Carson, let me ask you this. As a married couple, can you then write off $6,000 if you both have losses?
Andrew, that is a very good question. If you are a married couple, and let's say I'm an investor, you're an investor, and we both have capital losses of $6,000, we can still only write off $3,000 against our joint income. So you cannot combine them together and write off $6,000 for the year. Very, very good question. One more thing that I want to point out on this subject matter, Andrew, is that we talked about capital gains, but I also mentioned dividends as well. Now, there are two types of dividends that you may receive from your investments. They can be qualified dividends or non-qualified dividends. Now, I won't go into what non-qualified dividends are because, that's a little bit more wonkish for this lesson that we're talking about today. But just know there is a major difference and you need to know about that if it's in your portfolio. Non-qualified dividends are taxed just like money coming out of your 401k at your highest income tax bracket. So if you have non-qualified dividends, you will be, if you're in the highest tax bracket, you will be taxed on that dividend at 37%. If those dividends can be shifted to a qualified dividend, Andrea, now you get the favorable tax treatment like you would with long-term capital gains at 0%, 15%, or 20%. So always make sure that you understand the implications of your earnings inside of your investment so you can be more tax efficient moving forward.
Well, this is why you need a qualified financial advisor to help with these type of complex matters.
Absolutely. And we implore those of you who are actually in these positions to maybe reach out to one, or of course reach out to us so we can see exactly what your situations may be.
So Carson, I've heard you mention that some clients are exposed to an additional 3.8% on top of their taxes from investments. Why is that the case?
Yeah, Andrew, this is known as net investment income. And if you hit a certain modified adjustment gross income level, if you're a single person, Andrew, you make over $200,000 a year, or if you're a married filing jointly couple and you make over $250,000 a year, that is the moment in which you can be exposed to that additional 3.8% tax on your net investment income. Now, Andrew, what's important here is is for people to understand what is going to be included as net investment income. Now, we've already discussed some income like capital gains, short and long term, your dividends, your interest, any income on royalties or rent properties. It can also be passive income on a business. It can be income from the taxable portion of your non-qualified annuities. Now, these things are important to understand when it comes to your net investment income. So how's that actually calculated for you to fall into that 3.8% additional tax on that particular income? Well, I want to put on the screen a simple example so people can really understand how this is operated, because what they do is they tax you on the lesser of the amounts. The lesser of the amount above that income threshold that we mentioned, or your net investment income. So let's just take a look at a quick example, and I think you'll understand how this tax may apply to you. So let's just say that you have $10,000, Andrew, in net investment income, as you can see on the screen, and your modified adjustment gross income is over the threshold, whether you're single or married. Just keep in mind, single over $200,000, married over $250,000. But let's just say you're over that threshold of $25,000 in any situation. Now, that 3.8% tax is going to be on the lesser of the amounts. And so therefore it's going to be on your net investment income in this situation here of $10,000. So you will only owe an additional tax of $380. That's, 10,000 times the 0.038 or the 3.8%. Now let's also take a look at a second example here. Let's just take a look now that your net investment income is still $10,000, but the amount that you went over on the threshold on your modified adjustment gross income is just $5,000. In this situation, that 3.8% additional tax is going to be awarded to the $5,000, the lesser of the two, and therefore you will owe taxes on that amount of $190. So if you're in this situation and you're concerned about being taxed of an additional 3.8%, then maybe if you understand that that's going to be aligned to you, you can start working on ways in order to reduce your modified adjustment gross income. So maybe that won't be a category that you fall into.
So Carson, we are now in the holidays and gifts are a big thing this type of year.
Yep.
What are some tax tips that you can give around giving gifts as far as investments?
Yeah, this is another critical thing when it comes to trying to make yourself more tax efficient. A lot of people use gifting, Andrea, to of course reduce their estate taxes. There are really two things that people should be aware of here, Andrea. If you are a donor and you're alive, or if you're a donor and you're not alive, you're deceased. Now, it makes a huge difference when it comes to gifting. So for instance, if you are a donor and you're donating a gift to a donee while you're alive, the situation is not going to allow you to have the step up in basis. Basically, they are going to assume your basis. So let's just take an example here, Andrew. Let's just say that I bought a stock and at $1,000 was my cost basis at the time when I bought this stock. When I get ready to gift this stock over, let's say to our kids, the stock is valued at $5,000. That's the fair market value of the stock. At this particular moment, my kids are going to assume, if I'm alive, my original cost basis of $1,000. So if they want to take that stock and sell it immediately, they're going to have a capital gains of $4,000 on that position. Now let's say I'm deceased and that exact same situation came about. I have $1,000 cost basis. I gift that stock over and it's at $5,000. If they were to sell that stock at that moment, they assume a step up in basis of the $5,000. Therefore, if they were to sell that out, they will have no long-term capital gains because they've sold it out at $5,000, and that is their new cost basis. So it is really, really important that you understand that dynamic. Also, if you have a highly appreciated position in any asset, like a stock or real estate, you can donate that to charity, and you have a twofold benefit. One, you will receive a write-off up to a certain limit for that donation to the charity, and that charity can liquidate that position, and it won't create any capital gains for either side because it's donated to a charity. So these are things that people can do to help reduce the taxation of their investments if they're just trying to be more tax efficient.
Now, Carson, that was a wealth of information, so thank you for your insight on that topic, and thank you for watching. And if you felt that this information was beneficial for you, please like and share this video with others.
So I really do hope that the information that we shared with you today will provide you some insight on how to be more tax efficient when it comes to your investment planning. Please understand that these videos are created for educational purposes only, and that you should always seek out your own financial advisor, your own tax advisor, and your own attorney regarding your personal situation. Also, if you are looking for a fiduciary financial advisor to help you with these types of complex financial matters, we highly recommend that you reach out to our office and go ahead and schedule a complimentary 1-hour consultation with us today.
For more information about this topic or any of the other topics that we've shared in our other videos, please feel free to reach out to our office or leave any questions or comments in the section below. After this video, please check out our other videos that will give you tips on how to maximize your retirement. And if you like this video, please give it a thumbs up, subscribe to our YouTube channel, and share it with a friend. Thanks for watching, and remember, if you have questions,
we have answers.